Today, the Whipsaw Market Weekly Update. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, in our weekly review, we reflect on a chaotic week in the markets, from stocks through to crypto, even as stocks rallied at the end of the week in financial markets thanks to Federal Reserve Chair Jerome Powell reassurance that bigger rate hikes will be off the table for now, even after the hot inflation readings of the past few days. And separate comments from San Francisco Reserve President Mary Daly also backed half percentage point increases at each of the central bank's next two meetings. Well, 75 basis points or 50 basis points rates are still going up. But there is a clue in all this as to why we're seeing so much craziness in the markets at the moment. After sinking almost 20% from a record and flirting with a bear market, the S&P 500 saw a broad-based rally on Friday. It actually posted a sixth straight week of declines, though. That's the longest losing streak since June 2011. The Nasdaq 100 outperformed amid a rally in giants like Apple, Microsoft and Amazon, and meanwhile Elon Musk caused further chaos over his takeover offer for Twitter, first claiming his bid was temporarily on hold and then maintaining he's still committed to the deal, sending the social media giant into a tailspin. Tesla, though, jumped and treasuries fell with the dollar. Despite the strong gains on Friday, though, many traders aren't yet convinced that equities have reached a bottom after a sell-off that shaved $10 trillion from US stock values in just 18 days. Instead, they say investors should still brace for volatility, as the Fed's ability to fight price pressures without causing a hard landing may depend on factors outside the central bank's control. Actually, frankly, forecasting is a bit of a mess. Back in January, stock strategists known for their enduring optimism expected the S&P 500 to add 5% in 2022, and bond strategists weren't much better. Interest rate strategists and economists were calling for 10-year Treasury rates to rise to 2% by June, and yields took out that level in early February and then touched 3.2% this month. Now, of course, turns are hard to capture. That's nothing new, but this year a collective inability to forecast the persistence of inflation is probably the original sin behind wrong way calls. But such failures are hardly confined to the strategist class. Predictions on inflation levels derived from bond market trades were wildly off, and so were forecasts from economists and the Federal Reserve itself. The path of inflation took most people by surprise, said Chris Sullivan, Chief Investment Officer at United Nations Federal Credit Union. Not only has there been the quicker rate increases, but the move to quantitative tightening was much faster than last time, he added. All of these things were introduced into markets that weren't terribly prepared for them. That's a nice understatement, actually. Over the course of another tumultuous week for financial markets, some prominent voices on Wall Street pondered on the outlook for stocks after the powerful sell-off. Peter Oppenheimer at Goldman Sachs Group said on Tuesday that the rout had created buying opportunities with headwinds such as inflation and hawkish central banks already priced in. Meanwhile, Morgan Stanley strategist Michael Wilson noted that equities were still not priced for this slowdown in growth from current levels. So you can take your choice, really. There are 5 telltale indicators that are used to call a bottom in stocks, including spikes in the volatility index, puts sustainably outnumbering calls, and a dismal market sentiment, according to Lindsay Bell, Chief Markets and Money Strategist at Ally. And while the VIX has stayed near 30, past bear markets featured moves above 45. A volatility climax is a signature of market bottoms, she said. Much speculative froth has already been removed from the market, wrote Mark Halfey, Chief Investment Officer at UBS Global Wealth Management. So we advise against a hasty exit. Our central scenario is also that the recession will be avoided over the next 12 months. However, investors should continue to brace for high levels of volatility. We certainly revalue the stock market in a big way. Jim Paulson, Chief Investment Strategist at Leathhold Group, said, really great fear on Main Street, on Wall Street, combined with, I think, ongoing good fundamentals, including strong balance sheets in the household sector, the corporate sector, and the banking industry. I think that's a dynamite combination you have to buy on. Investor sentiment is at extreme levels and technical indicators are universally negatives, said Mark Hackett, Chief of Investment Research at Nationwide. This reflects the degree of pessimism embedded in the market, setting the stage for a bounce from oversold levels, which could be expected in the coming weeks. And that's worth just reflecting that all of these people make money on volatility and trades. So maybe it's not so surprising that we have such a broad range of views here. But of course, everybody's saying volatile, yes, but still trade. Maybe, maybe not. Equities, bonds, cash and gold all saw outflows in the week ending May the 11th, according to Bank of America strategist Michael Harnett, who wrote a note citing EPFR global data. At $1.1 billion, technology stocks suffered their biggest withdrawal so far this year, second only to financials, which lost $2.6 billion. Those are big numbers. The definition of true capitulation is investors selling what they love, Harnett said, citing assets like big tech, for example. Fear and loathing suggest stocks are prone to an imminent bear market rally, but we do not think ultimate lows have been reached. I actually think that's probably where I'm sitting at the moment too. Without the Fed creating something people feel comfortable with, it gets pretty ugly, said Jim Vogel, an analyst at FHN Financial. Some of the changes in the forecast now are, well, just sort of to keep up. In the fourth quarter of last year, as we started talking about tapering sooner and then rising rates this year, you saw financial markets reacting, Powell said earlier this month. That shows that the markets think that our forward guidance is credible. Yep, peaks just flown past the window there as well. Back in January, the consensus held that the benchmark gauge would end the year at around 5,000. Fast forward today, the S&P index sits near 4,000. Along the way, almost half of the strategies tracked by Bloomberg have lowered their year-end projections. At 4,837, that average target still points to an annual gain. It also implies an increase of 20% over roughly 7 months, a feat that, while not unachievable, is something rarely seen. Only 11% of the time in history has the S&P 500 been able to pull off such a rally. So shares in New York closed higher, ending a wild week of trading on a positive note, on bets that the Federal Reserve will lift US interest rates at a measured pace of, 50 basis points. Consumer discretion information paced all 11 of the S&P 500 industry sectors higher in New York, and the VIX fell 9.1% to below 2887. This bounce in US stocks is consistent with what appears to be a short-term oversold situation in the midst of still considerable long-term uncertainty and pressures, Mohammed El Arin said in a tweet. The yield on the US 10-year note was 7 basis points higher at 2.928. And the Dow Jones Industrial Average rallied 1.47% to 32,195. The S&P 500 rose 2.39% to 4,023, and the Nasdaq rallied 3.82% to 11,805. Oh, and by the way, the US Producer Price Index rose 0.5% month on month in April, which was slower than the 1.6% increase in March, thanks to the moderation of rising costs of energy products. So that may signal a little easing of inflation, but still, it's a big number. And the US released the initial jobless claims on Thursday, which rose to 203,000 last week. That was above the 195,000 forecast and 202,000 the previous week. Growth sectors of the market, including tech, flourished after the recent sell-off appeared to entice bargain-seeking investors back into big tech, with Amazon, Google, and Meta leading the charge. The return to favour of tech stocks has many questioning whether this is a short-term relief rally that could soon fade or the start of a more sustained move to the upside. It has been a rough few months for US stocks, but even rougher for shares of technology companies, and the widely followed and tech-heavy Nasdaq Composite is down about 30% since it peaked in November. And investors may be wondering whether tech stocks are a bargain. Well, the answer is no. They're a lot cheaper, but not cheap yet. In a note, Wedbush Securities' Dan Ives said, "This is not a dot-com bubble 2.0 in our opinion. It's a massive overcorrection in a higher rate environment that will cause a bifurcation tech tape with clear haves and have-nots of tech." Ives said he and his colleagues are holding fast on their bullish view of tech overall. "We have stress-tested our tech models and believe in a worst-case scenario. Street numbers for 2023 come down by less than 10%, while in a base-case scenario they're unchanged from today, and in a soft landing scenario actually go up from current numbers. We believe these stocks are pricing in a hard landing with fears abound." One way to measure tech's decline is to track how much valuations have contracted. The Nasdaq's forward price earnings ratio, that's the PE ratio, based on analysts' earnings estimates for the current fiscal year, has tumbled to 24 from 42 at the end of 2020. That's a 43% haircut. But while that's a big move, it merely brings the Nasdaq in line with its historic price earnings average back to 2001, the longest period for which numbers are available. And tech stocks can get a lot cheaper. For most of the 10 years from 2008 to 2017, the Nasdaq's PE ratio was below that average and often well below it. Dipped to 13 during the 2008 financial crisis and it hovered around 14 or 15 for a good part of 2011 and 2012. That's still a long way from where the Nasdaq's trading now. It would need to decline an additional 40% to reach those levels, assuming analyst earnings estimates for this year are reliable. If profits come in weaker than expected, the decline would have to be even steeper for the Nasdaq to revisit its historic lows. The analysis is the same even after accounting for the fact that tech companies command higher valuations. While the Nasdaq's forward PE ratios have always been above that of the S&P 500 index, the extent of the premium has varied, and it too is down considerably. The ratio between the Nasdaq and the S&P 500's forward PE ratio is now 1.4, down from 1.6 at the end of 2020. But that's also roughly in line with the historic average and well above the lows. The ratio dipped down to 1.1 as recently in 2016. Another way to tell whether tech stocks have neared bottom is if they're starting to show up in value indices. Index providers define value differently, but a common denominator is valuation. Facebook parent Meta Platforms at 14 times forward earnings is already cheaper than prominent value stocks Berkshire Hathaway, Johnson & Johnson, United Health Group and Procter & Gamble, the cheapest of which trades at 17 times, and the others above 20 times, and Google parent Alphabet is 18 times, and that's cheaper than all but Johnson & Johnson. But many other former high flyers have further room to fall. Notably, even after a 44% decline from its 52-week high, Amazon is still trading at 49 times forward earnings, and Tesla is trading at 61 times despite a decline of 41%. Now, that doesn't mean tech stocks will fall further. Obviously, and investors looking for discounts in tech will find them aplenty. Indeed, those who liked tech stocks 6 months ago should love them now. But investors who are buying tech believing that the lows are in should take another hard look at the numbers. I think most of the damage has been done in the stock markets, but I wouldn't expect a big snapback to recover all the recent losses. Sean Bonner, founder of Guild and a former US naval veteran, said recently, flagging the threat of further upward surprises in inflation, which could further impact consumers. And of course, Ukraine is often referred to as the breadbasket of Europe. If a big portion of that is taken offline, then there could be more inflationary pressures on food, commodity stocks, which will affect US PPI and CPI, Bonner added. US consumer sentiment on the economy in early May dropped to the lowest reading since 2011, according to the University of Michigan Consumer Sentiment Index, which was released on Friday. Twitter, however, bucked the trend higher, falling more than 9% to $40.72 after Elon Musk said that he would put his takeover for the social media company temporarily on hold, citing concerns over fake accounts. And the Tesla chief executive, however, affirmed that he was committed to the take-private deal, and Tesla rose 5.71% to 769.59. Make of that what you will. The Twitter CEO said that he still expects Musk to follow through on his deal to buy the company. Consumer discretionary stocks were also involved in the heavy lifting of the broader markets, supported by a surge in reopening stocks. Las Vegas Sands, Wind Resources, and Norwegian Cruise Lines were the top gainers in the sector. Energy, meanwhile, continued to ride oil prices higher amid the tug-of-war between weaker demand and lower supplies as the war in Ukraine rages on. And in other news, Robinhood markets surged nearly 25% after Sam Bankman-Fried, the chief executive of crypto exchange FTX, acquired a 7.6% stake in the trading platform. And by the way, the upcoming week is going to be filled with a whole bunch of central bank speak, world leaders meet, and economic data that could show signs that the economy is losing momentum. Fed Chair Powell will speak on Tuesday, where of course he will affirm expectations that the Fed will stick with a half-point rate increase in June, and most of the US economic data will likely show that the economy is seeing a slowdown with manufacturing activity and that the housing market is cooling, while the US consumer is still doing its best, withstanding widespread price increases. Now, European stock markets traded higher on Friday also, regaining some ground at the end of a difficult week as investors continue to assess persistent inflation, aggressive monetary tightening, and the associated impact on global economic growth. The DAX in Germany traded 2.1% higher to 14,027. The CAC 40 in France rose 2.52% to 6,362, and the UK's FTSE climbed 2.55% to 7,418. European equities edged higher, with investors looking for bargains as stocks have been battered by worries that soaring inflation and tighter monetary policy will curb severely growth in the region, especially given the impact of the war in Ukraine. That said, the main European indices are still showing a fifth negative week in a row. That's the longest streak since February. Investors, of course, are continuing to monitor the geopolitical fallout from Russia's invasion of Ukraine as Russian forces continue to attack Mariupol's plant with artillery and airstrikes. And the group of 7 foreign ministers will be joined over the weekend by NATO officials to discuss potential bids from Finland and Sweden to join the military alliance. Moscow on Thursday threatened retaliation against Finland if it moves ahead with plans to join NATO. And German Vice-Chancellor Robert Habeck is warning that Russia could use energy supplies as a weapon to threaten NATO countries. European natural gas prices surged as much as 14% as flows from Russia via Ukraine dropped further due to interruptions at a cross-border entry point. And in corporate news, Deutsche Telekom rose 0.3% after the telecommunications giant reported strong quarterly figures, lifting its full-year outlook, boosted by its US unit, T-Mobile, along with growth in its European business. On the flip side, though, Norwegian Air Shuttle stock fell 1% after the budget carrier posted a loss for the first quarter, adding that rising fuel costs will partially offset the positive effects of increased bookings for the summer season. April inflation data from France and Spain remained at elevated levels, with the annual figure in France rising to 4.8%, up from 4.5% the previous month, while the Spanish annual rise came in at 8.3%, just lower than the 8.4% in March. And also industrial production numbers for March in the Eurozone showed signs of a slowdown. Now, the Bank of England may not have been as behind the curve as other central banks, but the country is still heading for more than 10% inflation and a recession if the central bank's forecasts are to be believed. So the data next week could indicate how pessimistic or worse, optimistic those forecasts are. Unemployment, retail sales and CPI inflation make up the UK data dump, which is coming in the next week. It would appear the ECB has finally come around to the idea that the inflation problem is not going to solve itself, with numerous policymakers in recent weeks indicating that July is a live meeting once net asset purchases end. And even President Lagarde hinted at such, meaning once again a central bank has eventually come around to the market's way of thinking, and probably too late to avoid substantial pain, With that in mind, the flash GDP and final inflation data will be eyed, but it's what policymakers have to say that's most important over the next week. And next week, there's plenty of them making appearances. Oil prices rose on Friday as concerns about faltering global demand seemingly outweighed the prospect of a European ban on Russian oil, tightening supply. US WTI traded 3.8% higher at 110.11, while the Brent contract rose more than 3% to 111.15. Additionally, gold futures fell 0.78% to 1,811, while the Euro-US dollar traded 0.3% higher at 1.0414. And the dollar index climbed to a 20-year high to 104.46. That's the strongest level since December 2002. So a strong US dollar rules. Asia Pacific stocks were up on Friday, although investors worried that high inflation would continue, which will drive central banks to further tighten monetary policy. Japan's Nikkei 225 rose 2.64% to 26,427, while South Korea's Kospi was up 2.12% to 2604. Hong Kong's Hang Seng rose 2.67% to 19,898, and China's Shanghai Composite was up 0.96% to 3,083. Beijing recorded a few more COVID cases after the officials denied the rumours that the capital city will be in lockdown. But major developer Sunac China Holdings made a local bond payment, but shortly after it announced a dollar note default. That's the latest example of cash first going to ailing builders' domestic creditors. The payment news comes a day after Sunac China defaulted on dollar debt worth about $29.5 million in terms of coupon payments, highlighting the growth divergence of the treatment of global investors versus their domestic peers as stress ripples through the real estate sector. The firm, which declined to comment, is China's fourth largest developer. In terms of sales, it closed at 458 in Hong Kong. Even as the clampdown on property triggered a wave of defaults among borrowers, holders of domestic notes have been receiving payments or sweetening offers on extension proposals. Most Chinese firms' payment failures in 2022 have been on offshore notes, a sharp reversal from previous years that left overseas creditors with billions in losses and waning power. The handling of local and dollar debt obligations has raised concerns about how different types of creditors are being treated in China's credit markets as borrowers grapple with liquidity crises. Offshore notes are typically subordinated to the domestic peers and are not secured by onshore assets, leaving global investors with little recourse in the event of a payment failure, even when the bulk of borrowers' debt is owed to those creditors. Now, here in Australia, Australian shares partially recovered from this week's sell-off on Friday as investors were reassured on the US interest rate outlook, and tech stocks were buoyed by strong results from US buy now, pay later firm Affirm. The ASX 200 rose 1.93% to 7,068 on Friday, but posted a weekly loss of 1.8%. Short-term risks around inflation, monetary tightening, the war in Ukraine and Chinese growth remain high and still point to more downside in share markets before they bottom, said Shane Oliver, head of investment strategy at AMP Capital. Afterplay parent Block led the Australian market, bouncing back from its day earlier 17.6% decline by rising 15% to 114.88. Zip also rebounded from its 6% fall on Thursday, leaping 5.9% to 99 cents. Oil prices advanced for a third consecutive session as investors weighed the prospect of a European ban on Russian crude imports and the COVID-19 outbreak in China. So Santos climbed 3.2% to $8.05, and Woodside Petroleum rose 2.7% to $30.40. All four major banks posted gains supporting the broader market, with National Australia Bank up 1% to 31.14. ANZ was up 0.9% to 25.39, Westpac rose 0.9% to $24, and Commonwealth Bank edged 0.1% to 102.28. Gold miners were among the biggest laggers on Friday as the precious metal dropped further, and Gold Road Resources fell 2.3% to $1.25, and Evolution Mining tumbled 0.6% to $3.43. And the Australian dollar was also swept up in the relief rally that galvanised global markets on Friday, as fears that aggressive tightening by central banks to control surging inflation will trigger a global recession moderated just a little. The local currency hit 68.29 on Thursday night. That's the lowest level since June 2020, before advancing on Friday, trading up to 69.40. And it suffered as China seeks to assert control over its COVID-19 outbreak, posing a threat to growth in the world's second largest economy. We remain concerned about the Aussie dollar in the near term because we're yet to see a trigger that could spark a U-turn in terms of sentiment, said Rodrigo Catrill, currency strategist at National Australia Bank. NAB expects the currency to fall to around 67 cents in the near term, adding that a break below that level will require a severe extension of the equity market rout and a significant decline in commodity prices. Earlier this week, Commonwealth Bank warned that the Australia and New Zealand currencies could fall a further 5 cents if China's lockdown continues for several more months. But the bank said it was confident that once lockdowns ease, the Chinese economy would snack back quickly because of the pent-up demand and policy support. Spot market iron ore fell to 130.93 US a tonne on Thursday, but futures in Singapore were broadly flat on Friday. Macroeconomic concerns have continued to weigh heavily on the equity markets this week as stagflation and recession fears continue to dampen investor enthusiasm, said Lewis Grant, senior portfolio manager at Federated Hermes. Company earnings have echoed those fears, with a large number of firms still citing major supply concerns. And Morgan Stanley cut its June 2023 price target for the S&P AX 200 to 7,150 from 7,350. And finally, of course, it's been a rough week for the cryptocurrency market, primarily because of the Terra ecosystem collapse and its knock-on effect on Bitcoin and Ethereum and altcoin prices, plus the panic selling that took place after stablecoins lost their peg to the US dollar. The bearish headwinds for the crypto markets have been building since late 2021 as the US dollar gained strength and as the US Federal Reserve hinted that it would raise interest rates throughout the year. A massive sell-off in cryptocurrencies wiped out about $200 billion of wealth from the market in just 24 hours, according to estimates from price tracking website CoinMarketCap. The broad plunge in the crypto complex, driven by the collapse in the Terra USD stablecoin, hit major tokens hard. Bitcoin plunged by as much as 10% in the last day to its lowest level since December 2020, while Ethereum dropped as much as 16%. As central banks across the world move to aggressively tighten monetary policy to fight inflation, digital tokens have faced selling pressure amid a broader flight from risk assets. Since Bitcoin has been trading in the $28,000 to $30,000 range for an extended period of time, the longer we see price builds at these areas, further continuation becomes more likely. It was last at 29,484, while Ether was at 2,034. So if you stand back and think about all this, you can see just how volatile things are. And really there are very few safe havens out there now. And whilst the Federal Reserve is trying to just slightly moderate expectations, even 0.5% rate rises in the months ahead will be sufficient to pull markets lower. So again, I think it's important to understand the difference between a little bit of a rally into further falls and the bottom. I would be very surprised if markets don't fall further from here. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.